Hi, I'm Shalini and welcome to today's market note. So, US bond yields jumped again last night, but why did that happen and what does that mean for the US dollar, especially against the yen and euro? Let's break this down quickly. So, what we saw happen in yesterday's US session was a reversal in bonds. Yields jumped after a few things. The Fed Reserve's John Williams flagged inflation may stay sticky. The FOMC minutes for the May 7th meeting showed the Fed isn't ready to cut until things get clearer. Japan also had a weak 40-year bond auction, and that definitely dented global sentiment. We probably also saw some profit taking after the earlier bond rally on Tuesday. So essentially, markets pulled back on Fed cut hopes, and that's supporting the dollar. What it means for the US dollar? Well, when US yields rise, the USD usually gains. Why? Because higher yields make US assets more attractive. So, and with Fed officials sounding cautious and sticky inflation still risk, traders now think the Fed will wait longer before cutting and are pricing in only 45 basis points of cuts now, down from 50 basis points by December of this year. So all these helps to remove pressure from the dollar and keep it supported in the short term. If we break down the two pairs that are most likely to be affected, it's the US dollar yen. This pair still has room to grind higher, and with yield spreads favoring the dollar, especially after Japan's weak bond auction and no Fed cuts in sight, I would expect it to continue to bounce off this key support level at 142 back towards 152 if momentum for the US dollar strength stays. For the euro dollar, it's more vulnerable to the downside because there is no strong reason to sell the dollar now that the tariff news is sort of done and dusted, unless anything catastrophic comes out in the next few days. With bonus headlines to watch the Euro-US trade talks, given that Trump had threatened and then took away the 50% tariff threat on the EU. They are going to start talking today and every other day until the tariff deadline of July 9th. So let's see what happens on that. And there was also a rumor yesterday with Lagarde, the ECB president, stepping down, which was denied, but do keep an eye on it because that could lead to sentiment of instability and possibly push the euro down. So my overall take, well, as I see it, the bond market is still the driver for currencies, even if there may be some market makers that say otherwise. And as long as yields stay up and the Fed remains cautious, the USD will remain supported. I'm also going to be watching the Core PCE for the US that comes out tomorrow because that's going to be a big clue as to whether the Fed is going to maintain their wait and see approach or if the possibility of a cut will come sooner. So thanks for watching, and if you found my content useful, please do like and subscribe, and I will catch you in the next market note. Thank you.